The Iran war stopped trading headlines weeks ago, yet today, Cornwell Insight told British households their July energy cap will jump to £1,850, an extra £209 a year. The ceasefire did not unwind the damage. Wholesale gas doubled in February and March when Tehran shut the Strait of Hormuz, and Ofgem prices the cap off those very months. So the bill arriving in July is the bill written in March, regardless of where Brent trades tonight. The obvious read is that this is a household story. It is not. Shell's annual meeting at Heathrow this morning showed where the same shock lands on the listed side. A Follow This resolution, asking Shell to model a structural decline in fossil demand, pulled 12.7% of the vote, down from 20.6% last year and a 30.5% peak in 2021. Capital that had been drifting from oil majors into transition-themed funds rotated back. Index buyers and income mandates re-anchored to Shell precisely because Q1 profits were inflated by the same Hormuz premium now squeezing the consumer. The activist case weakened as the cash case strengthened. That is the tension that chapter cannot close on its own. The cap is set, the dividend is defended, and Cornwell warns that even a ceasefire tomorrow will not return autumn bills to April levels. Domestic spending power tightens into the same quarter that Rachel Reeves is expected to scrap the September fuel duty rise on Thursday. Fiscal room shrinks while corporate cash flow widens, a split the next chapter has to explain. The split surfaces inside the labor market within hours. Standard Chartered, headquartered in London, announced 7,800 back-office cuts by 2030, 15% of its support functions, and Bill Winters described it not as cost-cutting, but as replacing lower-value human capital with investment capital. That phrase is the causal hinge. The same cash flow strength households are funding through their bills is being redirected into automation rather than payrolls. The macro print made the timing brutal. ONS reported UK unemployment at 5%, payrolls down 100,000 in April, and vacancies at a 5-year low. Deutsche Bank's Sanjay Raja said the figures would stop the MPC in its tracks, which matters because every basis point the Bank of England holds back tightens the discount rate StanChart's rotate target is measured against. Winters is aiming for over 15% rotate by 2028 and a 20% lift in income per employee. Both numbers only clear the hurdle if AI capex compounds faster than headcount attrition would have. The flow this names is specific. Institutional rotation into StanChart on the strategy update lifted the FTSE banking line, while retail-exposed payroll names absorbed the redundancy news on the other side of the ledger. The countersignal sits at Monzo. Pre-tax profit jumped 44% to £87.3 million. The customer base reached 15.2 million, and Diana Layfield pledged European expansion. A challenger bank scaling staff and subscribers while the incumbent sheds its support layer is not the same trade. It is the same AI thesis priced into two different equity stories. What the chapter leaves unsettled is whether the productivity gain shows up before the unemployment print forces a fiscal response that erodes both stories' margins. The productivity question lands hardest on the part of UK PLC that cannot reprice labor out of its problem. Heidi Alexander confirmed HS2 will cost between £87.7 billion and £102.7 billion in 2026 prices, with the first London-Birmingham trains delayed between 2036 and 2039, and full completion pushed as late as 2043. Only a third of the overrun is inflation, 2/3 is scope and inefficiency. The line that Capital will trade on is Alexander's own. Cancellation would have cost almost as much as completion, which prices a structural premium into every domestic contractor still on the project. That credibility discount carried straight into Babcock, where Sweden today selected France's naval group for a €3.7 billion frigate order instead of the British bidder, on a day Babcock was already taking a £140 million hit on Type 31 reworks. The capital flow is named in the tape. Defense mandate buyers who had treated UK shipbuilding as a NATO-linked re-rating story trimmed back, while passive index flows absorbed the drop. The contrast with Standard Charter's AI trade is the point. One British large cap is repricing labor into capital, the other is watching foreign sovereign capital walk to a French alternative. The leaning is toward continued pressure on UK domestic equity beta into the autumn cap reset. Energy bills compound household weakness. StanChart's 15% ROTE target needs an AI dividend that has not yet shown up in payroll data, and HS2 plus Babcock confirm that long-duration UK industrial cash flows now trade with an execution discount. The recovery case is real but narrow. If Cornwall's autumn cap forecast falls back toward £1,641 and Reeves delivers targeted support on Thursday, the same Hormuz-driven cash flows lifting shell will broaden into the wider FTSE without needing the labor market to clear. The benchmark to watch tomorrow is whether the £1,850 July cap holds in next week's Ofgem decision, and whether Babcock's order book guidance after the Swedish loss falls below the £140 million Type 31 charge already disclosed. If either breaks the wrong way, the leaning is right. If both hold, the cash flow defense is stronger than today's tape suggests. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.